welcome to this breaking news. The International Monetary Fund has released its World Economic Outlook report. The IMF has warned of risks to global growth outlook. The global growth forecast for 2016 has been cut by 10 basis points to 3.1%. The forecast for the next calendar year has also been trimmed to 3.4%. Ritu Singh joins me now to take us through the details of this report. Ritu?
Well, as you pointed out, the global growth forecast for 2016 and 2017 both have been cut by the International Monetary Fund. For 2016, they've projected the growth at 3.1% versus 3.2% is what they had projected earlier in their April report. They've also cut the global growth forecast for 2017 to 3.4% versus 3.5% that they had projected earlier. The main reason why there is a downward revision is because of the potential outcome of a Brexit, which is UK exiting the European Union. In fact, the IMF goes on to point out that before Brexit happened, before that infamous June 23rd voting happened, when Britain chose to opt out of the European Union, the IMF was all set to raise the forecast. In fact, they said there were a lot of positive signs in the first half of 2016. For instance, data from the European Union, from Japan, showed some signs of a recovery. There was also some recovery in the commodity prices, and therefore they were on the back of that, they were prepared to revise their projection. But because of this Brexit and the uncertainty surrounding that, they have cut the forecast for 2016 and 2017. It is pretty obvious that the worst hit countries will be the United Kingdom and the European Union, but there will also be repercussions for the other countries. So if you look at the emerging markets and the developing economies, both their forecasts have also been cut. Emerging markets are projected to grow at 4.1% in 2016 and 4.6% in 2017. For advanced economies, it has been cut sharper to 1.8% growth for 2016 and the same growth rate for 2017. Individually, United States growth forecast has been cut to 2.2% for this year and 2.5% for 2017. Euro area, which is where most of the activity will be after this Brexit, is their growth rates have been revised downwards to 1.6% for this year, 1.4% for next year. United Kingdom, in fact, has seen the sharpest downward revision at 1.7% for this year and 1.3% for 2017, a big downward revision, obviously on the because of the outcome of the Brexit. The IMF goes on to point out that because of UK exiting the European Union, investors' confidence may be hurt, market sentiment may be hurt. There will be medium to short-term volatility in the financial markets. This forecast, of course, reflects the assumption of a gradual drop as well in the uncertainty going forward. This is a baseline scenario where this is what they're assuming the growth will come to. If the outcome of the Brexit is worse than what the IMF has imagined, it could even fall down to lower. But very interestingly, emerging markets have also not been spared. So India's growth forecast has also been slashed. Remember, they had projected a 7.5% growth for both 2016 and 2017, which has been revised down marginally to 7.4% for both the years. The reason for this cut, according to IMF, is that the cut is because of a sluggish investment recovery. But let's now cut across to the IMF briefing on this very World Economic Outlook report that they have just released in Washington, D.C. The IMF Economic Counselor Maurice Obstfeld is addressing this press conference.
The United Kingdom's June 23rd vote to leave the European Union adds downward pressure to a world economy at a time when growth has been slow amid an array of pre-existing risks. The first half of 2016 revealed some promising signs. For example, stronger than expected growth in the Eurozone and Japan, some recovery of commodity prices. As of June 22nd, we were therefore prepared to upgrade our 2016-2017 growth projections slightly. But Brexit has thrown a spanner in the works. The new EO update gives our revised numbers compared to April, when we were predicting 3.2% global growth of output in 2016 and 3.5% in 2017. Today's WEO update downgrades both of those numbers by 0.1 percentage point to 3.1 and 3.4% respectively. Relative to the April baseline, this new baseline concentrates the growth slowdown through 2017 in the advanced countries. Overall, outside the advanced economies, gains in the emerging country group are balanced out by losses in the low-income group. The growth reduction in sub-Saharan Africa, which is largely driven by two of the largest countries, Nigeria and South Africa, has a dramatic implication. In 2016, regional output growth per capita will actually be negative. In other words, output growth will fall short of population growth. Our revision incorporates projected negative effects of Brexit, but also other developments since April that led us to adjust the outlook. Naturally, the direct effects of Brexit are greatest in the United Kingdom. They also affect Europe to a significant degree, but our projections for other areas are little affected by Brexit in the baseline scenario. Despite an uneven distribution across regions of the world, our overall growth downgrade for the baseline global projection is moderate, and it reflects, among other things, a relatively benign assessment of Brexit's negative impact. That scenario, however, is based on country-level information that is available now, and now is less than 4 weeks after the actual Brexit vote, so that's a very limited span of information. It is important, therefore, to underscore that the real effects of Brexit will play out gradually over time, perhaps over many months, adding elements of economic and political uncertainty that will have to be resolved over a long period. This overlay of extra uncertainty, in turn, may open the door to an amplified response of financial markets to negative shocks. Thus, while our modestly reduced central scenario is, in our judgment, the most likely, there are other downside possibilities with substantially lower growth in Europe and palpable spillovers outside of Europe. Because the future effects of Brexit are unusually uncertain, the WEO update presents two explicit downside scenarios. These are model-based scenarios. One that is moderately worse than our baseline and one that is significantly worse than the baseline. These scenarios are driven fundamentally by the uncertainty Brexit introduces about the UK's ultimate trade relationship with the remainder of the EU and with the wider world. There's also uncertainty about the length and contentiousness of the negotiations, of markets' difficulty in gauging how the resulting uncertainty will depress demand, specifically investment, consumer durables, and hiring. And these scenarios also take account the possibility of a financial tightening that leads to widespread banking sector distress in the euro area. For the alternatives to develop the international trade effects of Brexit, the negative effects would have to be more disruptive than we now think is likely. And moreover, the effects of economic uncertainty on demand would have to be greater than is yet evident in the data. But in these scenarios, those effects are high enough to trigger severely negative financial feedback loops. Indeed, a main reason why we place less weight on those alternative scenarios, especially the more severe one, is that financial markets have proven resilient in the wake of the referendum. They've repriced.
All right, that is IMF's growth cut across the board. Now, breaking news on your screens.